Hey San Diego, welcome back to the Apartment Geek Weekly. I'm your host, Chris Robinson. Hope everybody's been doing well out there. Last episode, we spoke about returns and not overthinking returns, keeping it really basic, cash on cash return, return on equity. What's this investment going to give me net after everything, as a function of my dollars invested into the deal, my down payment plus any kind of capital improvement money, painting the building, landscaping, etc. So got some really nice feedback. I'm glad it kind of pointed people in a direction to, again, kind of keep it simple and to really focus on the numbers going into these different properties. Today, I'm excited about the topic, and it's basically the pitfalls of buying real estate. So I'm going to kind of go through a list that I created, and these are things that I've seen take people I don't want to say in dangerous situations, because anytime you buy real estate, typically it's good, but these are the things to kind of watch out for. And I can see people getting distracted and getting kind of in trouble if they don't pay attention to these things and kind of fall into it. So I want to start with ego being one of them. And I've seen this come into play, especially with myself, where there was a listing that came up, there's a competitive environment, and I wanted to buy it almost because I wanted to prove to the marketplace that I could beat out everybody else, or I wanted to beat out everybody else. It was almost like an internal competitive thing. And I've seen myself on one particular property in Pacific Beach where I did this. And I think in hindsight, I wish I wouldn't have purchased this particular apartment complex. It's just been kind of a pain in the butt. And really, it's not what my business model is about. I kind of got distracted by this internal desire to show people or prove to myself that I could beat out these other people that wanted to buy the real estate who were very successful as well. So ego. So understanding the role of ego and the fact that it kind of get us distracted. Not understanding the why. Why are we purchasing this real estate? Is it for us to live in? Are we going to live in it and rent some of the units out? Is it going to be for cash flow, for your lifestyle and your family? Is it going to be for tax shelter, which would be a totally different kind of property to purchase? Or you're only looking for appreciation, for more of like a long-term retirement plan. So really understanding the why and being clear, what are the goals of buying whatever particular property it is that you're looking at. Not factoring in ample reserves for repairs and maintenance. So poor budgeting. I see a lot of people that don't, their repairs and maintenance are just really light. And you're buying a building built in the 50s, 60s, 70s. A lot of times there's stuff that just comes up, and to not budget is foolish from the beginning. And if anybody wants to know what we use per unit per year, we have some metrics that we use as kind of boilerplate for your standard older apartment building in San Diego, for example. So if you're curious, let me know and I can help you with that. This is a big one, working with a broker that's outside of the specialty. So getting, if I have a listing on a 20-unit apartment complex, I'm representing a client, and I get a call from a loan broker in residential real estate that's representing a potential buyer. This is kind of a crazy example, but we get people that are in residential representing commercial property transactions, and what we do is very specialized with the paperwork, the disclosures, what we look at, who the inspectors are, who the appraisers are, and to go with brokers because it's a personal relationship, like, oh, I'm really good friends with this person, I want to give them the business. That's dangerous. I get that people are loyal, but if you're getting out of the broker's specialty, go look for somebody else who can represent you better. Whenever I purchase a residential house for myself to live in, I would never try to represent myself in that. I always go through a residential broker. So I think kind of staying in your lane with who you're working with and understanding what their specialty is huge. And I see people get in trouble if they don't do that. not exploring all financing options. We've talked about this before, where people go, oh, I've got this relationship with this person, this bank, or this lender. I'm just going to go through them because I've known them for 20 years. That's not a beginner's mind. It's somebody that has been around and they kind of think they know everything. And I've given some referrals out recently because I think it's really nice. People have reached out and want other options for debt, for financing. So keep the horizon wide open on who is giving the best money out there, financing, and go with who's going to match up with your goals, what you're looking to achieve. Being too nice with the tenants, I don't know if nice is the right word, but being too close with the tenants, we've talked about this in several episodes, keeping an arm's length distance, being friendly but firm. It's professional. This is a business. If people get too close to the tenants and then start getting too involved, then it's harder to raise rents. It's harder to be firm. It's harder to give a notice if somebody does not pay. These are businesses that should be run very black and white, and sometimes there's gray area, but it's black and white. And if the credit card company doesn't get your payment for the monthly statement, then they're not giving you another 2 months to pay it. You get penalized and you pay 20% interest rate, etc. So these are businesses, and they need to be residents need to be respected and appreciated because they are, but keep it professional. Unorganized, not good record keeping. I see this a lot. And if you get into this business, understand, and if you're not a good person with Excel or record keeping, income comes in with the rents, expenses go out, keeping track of these things on a monthly basis. If you're not good at that, it's okay. You can hire a bookkeeper or somebody to help you. Your CPA can do it, maybe as part of their team approach. That's what I do. I've got a CPA, and the CPA's got staff, and they help with bookkeeping and stuff for organizing the profit loss statements on these apartment complexes. So I see people get really, they get in trouble, and then they can't refinance because the records are all messed up. So if you get into buying real estate, organize your stuff and keep it tight. And if you're not good at that, hire somebody to help. Not doing inspections. This is common sense, but not. People generally are going to go in and do inspections. Look at the roof. Look at the plumbing. Plumbing is one of the biggest things that's a recurring expense because, again, most of the real estate in San Diego is old. Plumbing is old, and water is expensive to deal with. So plumbers make a lot of money out there, and you got to be really careful. One pitfall is not hiring a camera person to run a camera scope in the main sewer line that goes from the property out to the street where it connects with the city. I had a building in 5-unit Oceanside 10 years ago, and it was $30,000 issue to deal with this basically corroded sewer line that we didn't know about because we didn't have a camera go scope it when we were in escrow. And it caused a ton of issues, and we had to basically dredge down, and it was like a huge plumbing issue, and it messed up the unit, and it was just a nightmare. So always get a sewer line, do your inspections. If you're getting represented by somebody that's not in apartment complexes, figure out who the right inspectors are for multifamily, for apartments in San Diego. We know them all. We know the good ones and the bad ones, and so if you need an inspector referral, ask me. Not being cognizant or conscious of prepayment penalty when you go in with the loan. So you go in, you just sign, oh, this is a good deal, blah, 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 it's fixed for 10 years, etc. Know what the prepayment penalty is, because if you want to refinance, or if for some reason you want to sell that asset in 1031, know what you're dealing with on the prepayment penalty. A lot of people don't pay attention to that in the beginning. Buying too far away for management. So buying something that's 2 hours away, or it's in, I can manage this, it's out in Temecula or Inland Empire, maybe that's a good investment. I'm not judging on that, but being able to go to the property fairly easy. And if you can't, or it's just too much of a drive, then having management that's close, who you really trust. And that's another thing, is going with a management company who you just think is good, or somebody said they were okay, whatever. You have to really, really critique your management company if you are going to hire professional management in buying income property. It's not just getting a good deal on the percentage that they charge, but really understanding who your contact is, when do they work, what are their policies and procedures, etc. Getting sucked into vacation areas because they're hip, they're sexy, the ego says that's the cool thing to do. My friends will really like that. I'll be the cool guy in the block with rental property in Jackson Hole, Wyoming. Or I'm not saying that stuff's bad. My whole thing now that I've kind of evolved on is, if you want to use that for personal use and that's your vacation spot to spend your time, and that brings happiness and joy, then I'm all for it. Go for it. Vacation homes, totally cool. But if you're putting all this down payment into a property that you're going to rent out most of the time in these vacation areas, I would be cautious of that, and I would still focus on the fundamentals of an area like San Diego that's a year-round lifestyle destination where people want to live here forever, for good. And it's not kind of a vacation area that may have its ups and downs, or its swings between seasons. So understand, if you're doing that, really the why you're doing that is this really over the whole year, is this going to make sense? Cash on cash, return on equity, etc. Negligence with health and safety. This is a big one, because if you're negligent and you don't fix a big crack or a hole, or something falls and hits somebody, different things, railings that are falling over, etc., then you can get sued. And it's really, there's a lot of exposure that people have when they own real estate. They're owning something where people live on the site, they come, people visit, they have friends over, etc. So you've got to keep your properties safe and be mindful of anything that's blaringly unsafe, big cracks or things where people could fall, etc. A lot of times the insurance companies now are going out and kind of doing that for owners, where they will do a little checklist and make the landlords go and fix the issues, and then prove that they've been fixed. Not having an impound account. So when you get your loan, set up an impound account every time. That's the account that's going to pay your property taxes and your insurance. The property taxes in San Diego, thankfully for Prop 13, is good, but still a lot of money. You're buying a $5 million building, and your taxes are 60 grand, 70 grand a year. We don't want to have to make those big lump payments every multiple times a year, twice a year. We'd rather have it built into the mortgage payment. It's easier for budgeting. It's easier to calculate your draws. It's less thinking that you have to put into it as far as the budgeting and the accounting. So always create or have an impound account set up when you purchase property for the property taxes and insurance. Overthinking it. This is going to come into the psychology of buying real estate. So overthinking it. It's too old. It's too expensive. San Diego's gone up so much in value. The units are in kind of crappy condition. The tenants aren't keeping their interiors decent. People getting kind of overthinking it, and I see this all the time, where people look at investors want to get into the game, but something talks them out of it, and typically it's just kind of a nonsense issue on why they get talked out of it. And the example that I always come back to is my dad, who purchased the house that I grew up in North PV, La Jolla area, for $75,000 in 1979. And the mindset at the time was that was overpriced. It was crazy. It was kind of like the same mentality that we see out there today, where people are buying homes for $2-3 million, and it's very expensive, and nobody can believe how much the values have gone up. So when you're in an area like San Diego and you're on planet Earth where the population grows, people want to live here, and the demand to live in San Diego is only growing. So what looks like it's expensive today is just going to get more and more expensive in San Diego, whether that's an apartment complex or a house. But I love the example of $75K in 1979 for a beautiful house that at the time was overpriced, and kind of, maybe there was an angle of overpaying, or this is a crazy investment. Last but not least, thinking about the sale or thinking about it, real estate as too much of a short-term deal. In stocks, we put the money in, we expect profit, we expect a return. If it doesn't go up in a day or a week or a month, we're disappointed, and our expectations are let down. Real estate will always go up in value if you're in a good area. So just focus on the numbers and the cash flow. Don't think about the sale of the asset. Don't think about the short term. I would focus more on the cash flow and the numbers and the operations, and making the property look good. If you purchase something, add value to it, make it better than it was before you purchased it, whether that's aesthetically or raising the rents and increasing the cash flow, landscaping, paint, all kinds of stuff we talked about, new policies with the tenants, new rental agreements. Make it better and focus on that, because the appreciation will just come naturally. But it's a long-term deal, and if you go into real estate today, think about owning that property for 5 or 10 years or more, not getting out right away. So that's the list. Hope that's helpful and kind of gives people some mental notes to kind of get in there. I love the one about ego and about talking yourself out of doing a deal or not for the wrong reasons. If something is expensive and you have to really stretch to buy it, but you feel like it's a good location, or this is going to be a cool property long-term, profitable property long-term, I should say, just buy it, just do it. Because if you get in the game, this is an amazing business to scale over time. And the hardest part about it, we talked about, is just getting in the game. Once you're in, you're going to figure it out, and you're going to understand it. You go, oh my gosh, this is a cool business. And then you'll be addicted, for lack of better words. So thanks for tuning in. Look forward to seeing people next week. We've got a really cool topic coming up as well. Let me know how thoughts or questions or comments. I love the feedback, and be well. Thanks.